I want to thank each of the persons in the room for being with us today. This is a webinar specifically about managing investment risk in long-term mandates. FCLT Global's purpose for convening these webinars is to apply research and also to acknowledge precedent that is being set in this area of using long-term mandates, including to manage investment risk, ultimately for the goal of moving money in a long-term direction through risk management. This is a fundamental purpose for FCLT Global. My name is Matt Leatherman. I am with FCLT Global and will be your moderator today. We'll offer 2 points of reference for audience members in our room from our research. The first is called Balancing Managing Risk for Multiple Time Horizons. And the second is called Institutional Investment Mandates, Anchors for Long-Term Performance. Both will be subject to discussion today with a focus on the mandate element of that intersection and are available on our website. Each of the 3 individuals who you see on our panel today represents an organization that is leading the marketplace in using long-term mandates to create focus within their organizations and to begin to think about risk as well. First, we have Ahren Estabrooks, who is the Director of Global Equity Managers at Ontario Teachers Pension Plan. We also have Carol Geremia, who is President at MFS. And we have Dan Godfrey, a Senior Advisor from Federated Hermes in London. I want to thank each of you for being part of our panel today. Before we dive into the content, I'm going to offer a few programming notes. We are still operating in a virtual environment that is relatively new. Technical difficulties do come up. If that's the case, including potentially for me right now, I realize, please email bryn.costello, bryn.costello at fcltglobal.org to troubleshoot that. Also, this is a panel structure and a webinar structure for us. We are not going to open the microphone fully to the audience, but we do want to include you and to take questions. You may submit questions electronically to my colleague Victoria Tellez at victoria.tellez, T-E-L-L-E-Z, at fcltglobal.org. Begin moving to your questions just past the midpoint of this conversation. I also want to say that this webinar is being recorded. It's a public webinar in the spirit of continuing professional education that FCLT Global will archive on our website. It's not meant for attribution, but rather for investors' benefit only. We're in an hour-long setting today. Those who wish to stay past that hour will also have the chance to view a brief montage video that we have shot with other investors also talking about the utility of long-term mandates. My job now is to begin getting out of the way so that you all can hear from our extraordinary group of panelists that we have assembled. So let me first throw it open to each of you. A very straightforward question. What impact do mandate agreements between an owner as a client and a manager as an agent of that client have on your ability to focus on the long term? Carol, perhaps I'll start with you.
Sure. Thanks, Matt, and thanks for having this and all the good work that FCLT has done. I think with mandate agreements and their impact to behavior and the start of the relationship is critically important. And I think probably historically we collectively have not spent enough time in terms of really making sure that the contract itself is really laying out the behaviors, the understanding, the commitment to both parties about what the expectations are. And yet, I think, unfortunately, still, even as you think about laying them out in the contract themselves, it's also the process of going back to that contract to make sure that the conversations are still happening based on what was embedded in there. So I think ultimately it's the best place to really outline the relationship. And I think, as one of my colleagues said at our last call, is you can't manage what you can't measure, but what you measure matters a ton. And I think we've got a lot of disconnects in terms of what those measurements should be. So that the contract's the best place to put it in documentation, and then just make sure you follow back up to ensure that everybody knows that that was the original agreement.
Ahren?
Yeah, and maybe I'll say the same thing in a slightly different way, but really to us, it's about creating that alignment. So, in the process of due diligence, both parties say a lot of things and represent a lot of things, and the contract is the first chance for you to collectively sit down and put everything you've said in writing, which sets the tone for the relationship and sets out, working for a pension plan, we have an extremely long time horizon to pay pensions. And we really want to be able to have managers realize value over time, and it allows us to spell that out for them.
Terrific. Dan?
Perhaps I can just develop on one of the things that Carol was talking about, which is that it's really important what you measure. And of course, many of those things we think of as being quantitative. But I think also in long-term mandates, if we're going to get it right, we need to also be measuring satisfaction with qualitative dialogue around what's been done, why it's been done, what's gone well, what hasn't gone well. And then relate that back to the aspirations of the original contract, which also need to talk about qualitative issues around long-term sustainable wealth creation, absolute targets as well as relative targets. And then we can start to have different conversations. So I do think the mandate pretty much drives everything, because there's that emotional realization that the mandate is going to drive you getting fired at some point in the future, or may drive you getting fired at some point in the future. And therefore managers will have one eye over their shoulder at that mandate. And if it's perversely incentivizing them to do the wrong things, then that's what they will end up doing. And I'm sure we're going to get into some of those sorts of examples of what goes wrong and how perhaps we can stop it going wrong as we go through this conversation.
Indeed, we will. There's a theme in each of your answers that this is the beginning of a relationship. And at the beginning of a relationship, you provide the frame for it. And that bears out throughout the course of it. That's a seminal and foundational moment for the relationship. We're very fortunate to have each of you on this panel today, because it's not a hypothetical for you. You've, in various ways, used longer term provisions in your mandates with relationships that are ongoing now. I'd like to draw out some of that experience. Perhaps, Ahren, this time beginning with you, about the way that putting this into practice has helped, or anything that you've learned from the initial practice of longer term mandate provisions.
Sure. I think some of the learnings have been around, clearly, speaking from the program I'm responsible for, which is primarily a long-only equity program, we tend to believe in stock picking, and that company managements that manage the company for the long term, picking those stocks is very, a great way to generate alpha, and we want managers to be able to focus on that. And so we have a bias towards those managers that think long term anyways. And sometimes even they may be used to these agreements being referencing shorter term risk and return targets. And sometimes it's about, educating them in terms of maybe about the firm itself, or even just referring, a plug for FCLT here is referring them to the website has often helped, explaining to them why we think the terms we are suggesting in the mandate would be helpful, and kind of explaining, while there's a bit of upfront work to some of the requests around changing the layout of the performance representation, for example, is a little bit of upfront work. It's a really easy thing on a go-forward basis once that kind of switch has been made, and it's just kind of pushing them across that line to get it moving is a bit of a trick. Thank you. Carol?
Yeah, I mean, there's so many different levels of this, but one of the things that I don't know if it was huge surprise, but the reality of the disconnect of even defining and putting more of a quantitative conversation or documentation of what time horizons you're talking about. So what we've said for many, many years is our goal is to outperform over a full market cycle. I found that the industry has no interest in defining what a full market cycle is, and I feel from an active manager, we got to be on our front foot about having a deeper conversation about what that is, at least in our minds, so that we can let them know that that's what we're managing to. And when you see the contracts, it's absolutely staggering. I have, they call it my Carol file, my misalignment file, of a lot of contracts that really talk about every different definition of a full market cycle you can imagine. But the industry's anchored us on 3 years. And really historically, whether it is accurate going forward or not, that's about half, if not less than half, a full market cycle. And if you don't really have that clarity in the contract to say, well, you'll generate this amount of alpha, or this is the target alpha that we're expecting over a 3-year time period, which we believe is full market cycle, in parentheses. If we don't go back and say, actually, where did you come up with that? How did you get to that number, so that we can better align in understanding that? Because our version of a full market cycle is longer than that. It's closer to 7 to 10 years. So it's trying to draw out that dialogue and pull it out more specifically, so that we understand the pressures. As Ahren's saying, that we might not be aware at the asset owner level, and we've got to get clarity there up front. Obviously, there's lots of other examples in terms of agreement on reporting, agreement on fees, different ways to incent behavior and get us aligned. But the definition is the one, like I said, right now it's unbelievable. It's all over the board.
Thank you for sharing that. I'm going to come back to the Carol file in a minute, but let's first go to Dan and ways in which this has helped your focus or affected your focus in practice.
I think two of the core issues we've got to deal with have been raised by Ahren and Carol. One is Ahren saying that we're hoping to stop pick companies with great management have long-term perspectives, and that's a great way of delivering long-term alpha. I actually think, of course, he's right, but I think about it more in terms of it's a great way of delivering the total returns that the members need to pay their pensions, and the alpha is just a consequence. That if you're good at doing that, you will beat the market, you will beat the competition. But making alpha the objective rather than seeing it as the consequence, I think, is one of the issues that the industry faces, which drives us to these shorter term time horizons, where 3 years is regarded as being pretty long term. And then Carol talks about the market cycle, and I think she's absolutely right. I mean, I did quite a lot of work on this, as I'm sure MFS have. And what you can say with some accuracy is a typical market cycle is maybe 6 or 7 years. But of course, there will be market cycles that are much shorter and market cycles that are much longer. And that's why I think, Carol, when you talk about outperforming the market over a market cycle, there needs to be a qualitative element in that, because I think that comes with an absolute return target. But in any event, if your clients are anchored on 3 years, you're going to need to have a conversation about, was this a market cycle or not? And that's a qualitative conversation. So that's why I think we need to be able to blend these things, to recognize that yes, we can set quantitative targets, but we actually need to have quality conversations rather than seeing those targets as being a precipice for success or failure.
I appreciate that a lot, Dan. Thank you. Ahren, I'm going to call on you next in a moment to respond to this conversation that you just heard between Carol and Dan and ideas that you take from it. I want to begin drawing out that risk element, though, because this is the content that we're focusing on today. And as you think about your response to that conversation, Ahren, I noticed that this is one embedded risk that owners and managers are attempting to address in their mandates, different perspectives or expectations about what the investment horizon itself is. I'm going to unpack that momentarily. Ahren, first, I'd like to get your perspective as a client, as an owner, about the views that Dan and Carol just shared.
Sure. A lot of elements there. I guess what Dan said about alpha is an interesting one, only because it introduces the idea that we have many competing priorities in terms of what our own objectives are. You know, I speak mostly through the lens of an equity investor, but there's various elements within Ontario Teachers. You know, we're reporting issuer, so we're reporting every 6 months. We're regulated firms, so we have regulatory filings. Our compensation plan is on a different time frame. So balancing those time frames is very challenging as an asset owner, sitting across from a manager trying to hammer out what exactly a market cycle is. And I think if you look at, you know, what value was done for value managers, like, you know, that cycle certainly feels like it's extending much beyond 3 years. I think most value managers would attest to that. So that's certainly a challenge. And then Dan brings up another good point around alpha in terms of what's the objective of the mandate. Is it alpha or is it total return? Again, there's some conflicts there in terms of how, to be honest, how we're compensated. I guess we've always taken the approach that the best absolute return is also going to result in the best alpha. And so for better or for worse, we have stayed anchored to the concept of alpha or outperformance within our mandates. But I certainly appreciate that a number of our managers invest with an absolute return framework. And it's when we put them together that we really think about the relative performance more strongly. But admittedly, our IMAs still discuss alpha expectation.
Dan, I hear some elements of risk to be managed in this conversation. Maybe not at the level of statistical investment risk, but rather at the level of operations and also alignment, which a mandate is very much meant to cover. I'd like to begin moving our conversation progressively toward that subject, specifically of investment risk. But I don't want to leave that open on the table either. What risk elements do you distill from this conversation about the relationship between an owner and a manager, and how can the long-term mandate?
So it seems to me that the key here is that there is an onus on an asset owner and their advisors to really understand the investment manager's process and how they manage money, what their value creation philosophy is. And I think if that is being done properly, then to a certain extent, you're holding them accountable for managing the money the way in which they said they would manage the money, rather than for the short-term consequences of that. You have a longer term. Now, of course, that doesn't mean you just give them a pass for several years. You're going to have reviews with them on a regular basis. But what you're really seeking to do is to understand what they've been doing and whether that is in accordance with the way you understand them to manage money. And then in terms of the risk is, from your perspective, that they stop managing the money the way you thought they were going to. Someone leaves, there's style drift, there's a takeover, there's some major event which throws them off course, rather than those short-term highs and lows and volatility. And what I would, as an asset, if I was an asset owner, what I would want them to see them doing is protecting long-term capital, rather than worrying about shorter-term volatility, particularly if I have a 200-year plus time horizon. Mm-hmm. I hope that's some sort of an answer to the question.
Absolutely. I'm actually going to pick up an element of that momentarily, but Carol, I promised you that I would bring it back to the Carol file. I presume, and I would like for you to tell me if I'm right or wrong, that this Carol file of potential time horizon misalignment is meant in some way to anticipate and control the concerns that Dan and Ahren just discussed. Can you respond to them?
Yeah, no question. And I think, you know, getting back to the full market cycle definition, you know, not everybody, the reason that people don't really want to define it because it just feels too long. So how do you manage to Dan's point, the whole relationship up to the end of the full market cycle, or what that goal period of time is? And there's no question, you know, as I always say to clients, the last thing we want this to come across as self-serving. But if we aren't clear about how we're allocating the capital responsibly on your behalf, and how we're managing the portfolio to time horizons, to not specifically to time horizons, but committing capital as long as we do, and we're not clear about that, then we're creating that misalignment, especially with the industry focused on shorter term markets, markers. I say to clients, measure us every day. 1, 3, 5, that's not the point. Those are markers to the longer term destination to make sure you're on track, like Dan talked about, to have that dialogue. Unfortunately, though, what we are experiencing, and I think why FCLT is doing so much of this work, is these shorter term timeframes have become the destination. They absolutely have become the destination of success or failure as it relates to alpha. And this is where I think the tragedy is that if we don't step up and have a better dialogue about saying, whoa, wait a second, when we say we're long term, we have to prove that to you. We can't throw away that term anymore as if it's just everybody gets it. So when we say that, we need to be on our front foot and say, okay, let's give you examples, not only in the dialogue of why we're continuing to commit capital to some of these underlying businesses in shorter term stress, but turnover, holding horizon, what is our average holding of a stock with inside our portfolios? What does that look like? So that we can actually really prove that we are committing capital at the level that we talk about, and why we manage portfolios for a full cycle. I think that is what is really missed because of the short-term pressures. I think as it relates to risk, though, coming back sort of, when you look at, somebody called it TINA, we're sort of all focused on equities here, right? There is no alternative now except equities or somewhere to get extra return. But the stat is unbelievable. Investors are now taking 5 times the amount of risk to get the same amount of return. And I was always taught for many, many years is when somebody says, how much risk do you want to take? And investor, the first question you have to ask back is, how much time do you have? If I don't get those two right, then I can't understand the amount of risk that I need to take on your behalf.
I'd like to jump in there and ask you to apply that exact insight to the mandate. The mandate's going to address the way that you measure return, risk, and time horizon. How do you integrate that insight into a mandate agreement? Carol,
I think you lay it out in terms of, just like I'm saying, I think expected returns and expected risk that you're willing to take to get those returns. But again, unless you're aligning with the idea of better time horizon alignment, I feel like that's still a complete open door question. But the industry is so focused on risk adjusted returns, or risk, without a conversation on time. Because time just feels like it is too hard to measure. And especially when you're paying fees. And so I think that's why this conversation, that's why it is so difficult.
And let me call you in right here and get a client and an owner perspective on that. How do you handle this from the other side of the table?
Sure. I guess 2 thoughts popped into my head there. Is one of the suggestions of the mandate project we did was around lengthening the tenor of the contract. And it is challenging from a client perspective to have an extremely long time horizon embedded in the IMA based on some need to be able to show that what you're doing is successful, and that's just the institutional prerogative that you need to be able to demonstrate that. And so we haven't tried to define a market cycle. We've picked a 4 to 5 year horizon as to when we assess performance. But one way I think which I pushed myself a little bit here is we've tended to insist on no lockups or any redemption fees on most of our equity mandates. We Teachers has a lot of private assets, and to make a liquid asset illiquid is a bit of a challenge. And so what we've done here is tried to create more alignment by meaning that we can't terminate for performance within a period of time without being subject to a penalty. Obviously, we want to make sure that we are able to act on significant staff changes or ownership changes or things like that, but we've allowed these other provisions to create better alignment because we realize that exercising the power that we have as a large global pension fund to have zero restrictions on us wasn't necessarily fostering that long-term thinking. So we pushed ourselves in that sense to kind of to align longer term as opposed to lengthening that performance expectation period.
And Ahren's referring to a term that we published in institutional investment mandates as well, a way to facilitate that commitment without having to technically lock up. I would love to get your thoughts about whether that helps.
Well, I think there's nothing quite like a wet signature on a long-term contract to give confidence that you mean it. And I did have an experience as effectively as the asset owner of trying to set up a vehicle and hire a number of asset managers to manage portfolios within that, and picking on a number of themes that Carol's raised as well. So the contract had an expected maximum turnover rate. It didn't mean that the managers would necessarily be fired for exceeding it, but it meant we would be having a conversation about why turnover was higher than they had expected it to be. It did have a 7-year life of the contract with a 12-month rolling on after the first 7 years to meet that expected business cycle. And it had an absolute return target, but it was acknowledged specifically in the contract, but also publicly, that if you set a 7-year total return target, that's really just an indicator. It's the first step to understanding whether you've been successful or not. Because of course, let's say you set a target of 7% or 8% compound return over 7-year rolling. We might look back at the end of 7 years and say, we didn't achieve it, but in fact, it's been a miracle. We've done a great job. Or you might look back and say, we smashed the target, but actually in the circumstances that pertained, it's not been very good. And it also looked, in terms of risk, it didn't take risk as being volatility relative to a benchmark. Risk was all about permanent loss of capital. So that's the way that I sought to do it. And actually, if I can just take maybe 1 minute more on this, one of the things that really surprised me was that I'd set the 7-year contract term really more as a message to me and my board's future selves to remember why we'd hired this manager when we started losing confidence in them, by making it expensive to get out of, other than of course there were break clauses for them not behaving the way we expected. But what I wasn't really prepared for was the impact it clearly had on the managers. And one verbatim example was a manager who said, look, we present ourselves as very long-term managers. We're known for being very long-term managers. That's why people buy us. But we also know that if we underperform the market 3 years in a row, then some of our clients are going to fire us. So we do manage our portfolio with an eye over our shoulder, looking at the benchmark. And with a contract like this, we won't do that. And we're really, G'd up by this because we believe we'll do a better job.
Thank you, Dan. I want to follow up on one point that you mentioned. You alluded to a different way of measuring risk in that contract. Rather than volatility, it was permanent loss of capital. And I'd like to take that as an opportunity to get very specific about investment risk within mandates. Why does it matter which choice that you make, and how would that choice be reflected in a long-term mandate?
Well, I think you will build a portfolio in a different way if you are trying to maintain some kind of measure of benchmark relative volatility, so that people worry that it'll scare the horses if your portfolio falls more than the market, or substantially more than the market. Whereas the reality is, if you're looking at the 200-year return or even a 10 to 20-year return, that short-term volatility really may be immaterial. What matters is not losing money forever by investing in things that can never either go broke or never come back. And those are the conversations you want to be having, or I would want to be having with the manager when that's gone wrong.
Thank you. I appreciate that. Sorry, Carol, let's go ahead and go to you.
Well, I was just, both in terms of what Dan and Ahren were talking about, so much of it is this mindset shift in terms of more clarity and understanding. And Matt, we talked about it on the call last week, is just the investment chain has gotten so long in terms of the intermediation between the end investor and the public companies. And we're really, what I think is happening is we're redefining what the role of what active management plays, and where you sit within that investment chain, how you're going to measure the risk of the portfolio, and what time frame are you now accountable for within the end asset owner's asset allocation. And I think that Ahren had talked about even the contract and fees and arrangements. We love the idea of lower for longer. This idea that we're in a way a private equity proxy in providing liquidity. In that you either believe that the holding horizon, if we're willing to commit your capital to underlying businesses that is triple the industry. We're holding companies for 5, 6, 7, 8, 9 years, that there's an understanding, to Dan's point, that's how we're putting the money to work. And that our whole system, our whole culture, our whole incentive model to get our investors to think long term is based on that premise. And that's actually what we believe will help drive long-term value for you. We think that's the only way we can allocate your capital responsibly. But if we aren't really crystal clear in all of our behaviors that plays out through to the asset owner, then we're missing the ability to change that mindset or that clarity of why we need to be aligned, and how we're managing risk on your behalf. And there's just so many elements to that go into it. And the only last point I'll make is that Ahren, I think his point of our lack of clarity sometimes is not understanding the pressure, whether it's board pressure, whether it's public pressure of what our asset owners are dealing with, and how do we help better align to give them the ammunition that they might need of who they've hired. But did you hire active management as exposure, or did you hire active manager actually for long-term value creation?
I want to dig into that question and follow up, and I'll put a particular frame on it. Owners and managers are observing one another's behavior and looking for signals about whether they share perspectives about risk and return. We're having a conversation specifically about risk. So Ahren, I'll go to you first. You've heard a lot from managers right now. I'm curious what behaviors by a manager signal to you a longer term or shorter term risk appetite, and also the ways in which you think you're signaling to them with your own behaviors.
Sure. Funny enough, I think the first one's easier for me. So really to us, it's about diagnosing in those conversations, what's in the presentation, obviously, but really when we get into stock specific questioning and portfolio construction questions, is really listen to what they're saying and try and see how that aligns with their stated philosophy on time horizon in particular, in terms of, are they really looking at the long-term value creation record of this company, or are they kind of talking about, the upcoming quarter's quarterly report? So we find that there's a lot of value in actually just the discussion with the manager, and that to us cues a lot of what they truly long-term. It is interesting just in discussing with managers, because we've only been trying to introduce explicitly these longer term elements for the last year or two, is how embracing they are of some of these suggestions we're making that are based on some of the FCLT work. And, I think we've so far been pretty good at identifying managers that align with us being long-term, so it hasn't been a lot of pushback, but you know, just hearing what they think about some of these provisions initially can have some signal. As kind of reflecting on my own, you know, certainly we talk a lot of talk in terms of being long-term. So I hope we do a good job of that, but it is hard because we don't put a presentation typically in front of an asset manager to pitch them to let them manage money for us. So really, I think it is mostly initially about how we talk, and obviously once the money's running, it's you have to walk the walk there, and not obsess about quarterly or monthly performance or anything like that.
Carol, let me ask the same question to you, just from another or alternate perspective, and then I'll go to you next, Dan.
Well, we had an interesting situation with our mutual fund board, as you guys know, and you know, so much of it was realizing that the way we were showing up at board meetings was actually suggesting more of the short-term conversations than not. And when we started to have this different dialogue with the board by talking about full market cycles and starting to talk about having a longer term view, they got very interested in terms of the whole dialogue. And what they came back to us and said, well, yes, we all talk about long term, but maybe we are a bit disconnected in what our view is versus yours. And so they asked us explicitly, tell us how you're really managing the teams inside, how you're compensating people to think long term, what metrics do you use, how are you looking at attribution. And through this whole conversation, it took about 2.5 years. And when we sort of just laid it out to them versus the board reporting that they would get, where your 3-year number is highlighted and you know year to date 1, 3, 5 was sort of the focus of the conversations, they actually stepped right into it and took an initiative to say, we want actually all the board reporting to change. We need you to change it. And so, you know, part of it was music to our ears because we said, okay, this is better. You're really understanding how we're thinking about the portfolios. So we changed, you know, the low-hanging fruit of putting the 10-year first and talking more about turnover as an explicit demonstration of committing capital. Even the attribution numbers where we were sort of sometimes throwaway on 1 and 3, we started doing attribution numbers, started at 10, 5, 3, and 1, which was a whole different view. And I'll tell you, what an incredible experience. It wasn't easy. The last thing I would say about it, ironically, was the board, the independent board became so interested in this conversation. We were almost nervous to have it because we thought it came across self-serving. But when we got closer with that dialogue, it just empowered more understanding. Where it was more difficult, though, was actually internally. I think there's just a tremendous amount of fear that you want to tell investors what you think they want to hear, because you know that they are measuring and they've got to hold us accountable every day, every week, every month to prove that we were a good hire. But again, we realized actually the way we were showing up was feeding in to that short-termism versus having sort of enough guts to say, well, no, actually, this is the way we really are thinking about things. And this is what we're focused on.
Thank you. Dan?
Well, I think totally agree with what Carol's saying there. And the tragedy is no one can do it on their own. No link in the chain, be it asset managers, asset owners, can go on their own. Everyone, to some extent, has been held accountable by someone who's measuring them in a way that is not helpful towards long-term investment. So we've got to find a way of all linking arms through that chain and moving together, because objectively everyone sees that we can not only generate better returns individually, but we can, through exercising long-term stewardship of the companies that we invest in, by promoting, encouraging, supporting them to think long-term themselves, we can be a force for good in a better market, not just better returns for our customers. So it's a crucial thing to do. But I always learn so much listening to asset owners, asset managers, listen to Ahren talking about the pressures that they have internally, which make it difficult. And of course, tracking error controlled, seeking small amounts of alpha has been it's been very profitable for the asset management industry, but it's a recipe for sustainable failure. Because whilst it's very difficult to outperform an index every year, it's very easy to make sure you don't underperform it by very much. And on any sort of law of averages, even if you're not very good, you may underperform 2 years by a bit, but then the third you'll outperform by a bit unless you're very unlucky, and then you get a reset. So it's not been a good way of generating long-term absolute returns for all the clients. I think that it depresses the performance of the market, not just investors' returns, and it's why the active industry finds itself under so much pressure from passive. And if we don't move to this longer term approach, if we don't do what comes with that naturally, which is stewardship and engagement, then I think that the active industry's lunch will be well and truly taken, and deservedly. So it's great that FCLT and firms like MFS are really pushing for change.
I'm going to go to questions from the audience momentarily, but I have two that I want to follow up with, both in the domain of why it's hard. The first, and we prepared for this last week, is that investors, whether an owner or a manager, their remit is limited on this conversation. You have GIPS compliance that also matters when you report between owners and clients, and it currently stipulates you have to use monthly volatility as your point of departure when it comes to the risk conversation. I enlisted a lot of strong views when we were talking last week, and I would like to draw out right now the way in which that limitation is felt in long-term agreements between owners and managers. Carol, perhaps I'll start with you.
Yeah, I think, we're probably less hung up on, we're used to all the industry, whether it's regulatory or compliance standards that are really, I think, actually important, so that reporting to the end investors and to the asset owners have standardization at some point for that equal footing. But we're less hung up on sort of the annualized monthly observation. What we're hung up is that it gets locked into a 3-year view versus looking at it 5 years. So we supplement all around that with longer time horizons. And so when we're sort of baked into requirements, then I think it's our job, like I was saying before, to make sure that we supplement information around that to push the conversation out to longer time frames. It's also like fixed returns versus rolling returns, really making sure that you can show consistency, and consistency over long periods of time is important. So what I do worry about with standardization and certainly regulation, and this is what I talk to so many clients, the pressure from the regulators even to think short term, or the compliance standards really, I think, need to be looked at more broadly to say, wow, what behavior are we driving? Because this is all sort of requirements that is unpublished information. And I was talking to a large CIO, or a CIO of a large DC plan, and he said, Carol, it's really hard to manage your DC plan, for example, for investment success, when your first stop is regulatory risk. And some of that behavior is embedded in the required reporting. And we see it a lot on the retail side because we manage retail assets as well. And that fuels some of the short-term thinking or the anchoring to the shorter-term markers versus help educate to the longer-term destination.
Ahren, you're a client who will receive this compliance version of reporting and then also supplementary materials. What's the experience like specifically with respect to risk?
Sure. So I one thing just to caveat is we don't actually spell out a quantitative measure of risk within our IMAs, because we do have some skepticism around these measures, and We are, like my colleagues probably, a bit more focused on permanent loss of capital or permanent capital impairment type of risk measurement. That said, we get the reporting from the managers anyways, and we also report on it internally. So we are familiar, we've discussed this very issue. I do understand that to use annual or longer data is difficult only from a statistical perspective, and that you need a lot of data to get meaningful numbers. So monthly is kind of the lesser evil there. And the other thing that kind of is interesting, just as you think about our philosophy, we like very concentrated portfolios. So we're willing, especially in the bigger the fund of funds type concept, we're willing to take significant month-to-month variation in a portfolio's returns if it leads to a more positive long-term outcome. And so to measure a long-term alpha over a monthly standard, a monthly annualized alpha is kind of mismatching timeframes. And so you're focusing on the month-to-month volatility, but looking at the long-term return, and those just don't seem well aligned, in my opinion. And that's why we don't rely on them too heavily, at least at my level.
I want to put two pieces together for our audience there that you've put onto the table, Ahren. You mentioned that you hope that managers and others are listening and hear words that you say just like that. Of course, they are, and they're also managing uncertainty about the extent to which they can be confident in that. You also earlier mentioned that you are willing to pay a penalty, or in some ways compensate a manager if teachers chooses to walk away from a relationship, not for liability related reasons, not for misbehavior, as it were, on the manager's part. And that seems like something that might bring commitment to the language you just provided. Does the package come together that way?
It certainly does now. I mean, as I said, prior to my engagement with you and the FCLT team, we were utilizing our size to our advantage to maintain that absolute liquidity and do what we want. We do act long term, despite what I'm saying there. But I think they do package well together. It really, it could be that we just take the good provisions that help us. But we recognize that if the manager is going to give in some sense to us, that we need to really step up and call ourselves out as responsible long-term investors to walk the walk, as a
Dan, before going to you, I'm actually going to add in a layer of the question that we're getting from the audience. We have our friend Michael from Sun Life, who has submitted a question more in the spirit of how this works internally. We focused a lot on the intersection between the owner and the manager, but there's been a couple of allusions throughout the conversation that you have to have unity of expectation and action within your organizations in order to bear out that relationship. And so within an organization, that's things like the way in which folks are compensated, the way in which they're evaluated, the way in which they're structured. And so can I throw to you, Dan, and then go to you, Carol, about specifically the way that happens within your organizations as you think about your relationship?
So in terms of the performance management conversations and compensation outcomes, they are very aligned to the overall mission and purpose of the business, which is to create wealth sustainably for the benefit of investors. But of course, there are a whole range of mandates behind that. I think one of the things that we need to look at as an industry, and that we're certainly looking at internally, is how are we articulating the objectives of the mandates, and are we really convinced that we are aligning that performance management and compensation conversation to those exactly to those mandates. And I think that to date, my experience of the industry as a whole has been that we're very, particularly with retail mandates, we've been very wishy-washy. Because we don't want to have any accountability if we can get away with it. So we say things like the objective of this fund is to generate long-term capital growth, full stop. And that's already beginning to change in Europe because of regulatory requirements. But I still think that if the regulators came to match how portfolio managers are compensated, they would find there's quite a lot of mismatch quite often against those publicly stated objectives. And so what you realize is that, in fact, the real objective is the way people get paid. And so I think that we need to line that up and be more public about not necessarily the compensation arrangements themselves, but what constitutes winning should be the way that we articulate what the objectives of that fund are. Otherwise, perhaps we're not being completely transparent about what we're really trying to do. It's hard to incentivize someone to do A if we're telling the market we're trying to achieve B.
Carol?
Yeah, echoing to what Dan just said, is certainly incentives are a big part of how you're motivating people. But on top of that, actually, what I would say is probably even bigger is culture. I think it's everything in terms of how you behave, how you run the business, how you think about managing employees, and then absolutely how you compensate them. I mean, for us, we do not pay on one-year returns. We haven't for many, many years. We really do focus on compensation on the longer term results, and if you don't have them because you may be a newer analyst or building up a portfolio, then it's something that is measured over time. It's about what type of products you're building. That speaks to how you're running the business. How do you manage capacity? I mean, the pressure to close products is really, it's there, but it's so critical to long-term value creation, is closing products at the right time, and making those harder business decisions. But employees need to see that behavior from the top, but they also need to see it consistently, not only in terms of how you manage the money, but how you're running the whole company, and that all is aligned. One of the things that we actually are working on a separate project, it's called Client Alignment, with a lot of investments into our business about how, to Dan's point, is we need to many times change how we're showing up, because you want to respond to the industry request or the regulatory request, but we have to step back and really self-reflect by even redefining who our client is. And to be really clear, we don't go direct to the market. We distribute our products through intermediaries, but we need to be clear to those intermediaries that we're actually managing money for the end investor, not the intermediary. And there's nothing wrong with saying that, but being really clear about that alignment and the role that we're playing, again, in that investment chain, and that we're running the business that way, and we're incenting our employees that way. And so as we show up in the marketplace, and I think Dan and Ahren said it earlier, it's just making sure that transparency, and I think actually your paper talks about it quite a bit, that transparency comes through, because if you don't say it, people don't know. And there's active management today is defined under a huge umbrella. And I think, again, defining that role and where you stand in the chain is really, really important, and how you behave.
I really appreciate that. I'm going to begin to move us toward conclusion. I do want to say for our audience, we may have time for one further question if somebody would like to submit it. Again, the email address to do so is victoria.tellez, T-E-L-L-E-Z, @FCLTGlobal.org. We'll see if we have time to work in one more if somebody chooses to submit that. I want to wrap up my questions to the panel by acknowledging that long-term mandates aren't necessarily easy, that there can be bumps in the road, and to draw on your experience to understand what sort of challenges can you run into. And as you think about our audience, a substantial one now on the line, who may be considering using long-term mandate provisions themselves, what advice would you offer to them about anticipating and overcoming those challenges themselves? I will begin, Ahren, with you.
Sure. I think I might have alluded to a number of my thoughts here earlier on, but advice-wise, I think most of us are on this call because we're all well aligned in terms of that we believe that long-term investing is the best time horizon to think about investing on. And what I would say is, given that you already have that natural inclination, is that this is really a series of nudges. I think, Matt, in other writings, you've referenced the book Nudge. It really is about just some incremental changes to probably what you're already thinking or already doing, and that it's not dramatic change. It's really about this idea of creating that better alignment and expelling it out explicitly, as opposed to somewhat assuming it, as maybe I did in the past. And really, the couple of hurdles that we've typically encountered are those, you know, from the manager side anyways, in terms of presenting to us, is just kind of the work to go into reprogramming to flip performance charts or other calculations that we ask for. And typically it hasn't been too bad. And then, as I said, internally, there is some of that natural tension between, you know, where I'm operating in a liquid asset class, and so it's not easy to convince everyone that I should be paying penalties for performance reasons, or you know, compensation. You know, different programs within teachers have different time periods, and so there has to be a holistic approach to incentives at teachers, and so not everyone is 100% aligned directly, but we're hoping as a team we are. So certainly some challenges, but I think personally it's been a pretty rewarding experience in integrating these into our contracts. I think we're up to 3 or 4 now.
Excellent, thank you. Carol, I'd like to go to you next. What's hard and how do you overcome it?
Yeah, well, I do think progress is being made, and you know, in a funny way, the conversations are hard, maybe in that I find they're inspiring, because I find that people want to have these conversations. There's something very ethical about taking a long view, and when you really have this open dialogue with so many great investors around the world, they want to have it too. It's just, how do you get, it's the devil's in the details, as we say. I think the reason we have to keep being so persistent on it, and why focused capital on the long term is so critical for us to be members and to be talking about this as a group, is that with returns continuing to be low, and the idea that people are taking on so much more risk and so much more complexity in their portfolio, their overall portfolios, to meet longer term results and obligations, the best way to manage that increased risk is to understand the power of time. It isn't just to not measure and just sit around and not do it, but it's really to understand the power of time in doing things the right way, and to have those open dialogues. So I'm actually, yes, it's hard. I find it's incredibly exciting that the industry is taking this on in so many different ways, and the more that we do it, the more progress and change we'll make together.
Thank you. Dan, I'm going to give you the last word.
Well, I'll try and be quick then. I think it's hard because we don't yet really have a safe space to do this to the max. It's difficult to do it because it's not what we're being asked to do, and if you're trying to do something that people aren't asking you to do, it's easy to get fired. So it's hard to really go the whole hog. But as Carol said, you know, we all know really that if we take the long-term view, if we invest with high conviction long-term in companies that can create wealth in a sustainable way, that's the best job we can do for the underlying members. So whether it's the investor who's coming through an advisor or the member of a pension scheme, they're the ones whose capital ultimately we're managing on their behalf, and that's what they need. And yet we have this huge disconnect. I think I realized from Ahren where perhaps I've been going wrong is focusing on revolutionary change rather than the steps and nudges, and it didn't work out so well for me last time I tried it. But it's great to be associated with companies like Federated Hermes, in this club with FCLT and MFS, where people are really trying to create that safe space. And I think that's the way I would look at it, where we can do what we know to be right in a way that's viable for us commercially.